Hello, and welcome to Macro Minutes. During each episode, we will be joined by RBC Capital Markets experts to provide high-conviction insights on the latest developments in financial markets and the global economy. Please listen to the end of this recording for important disclosures. Hello, everyone, and welcome to this edition of Macro Minutes called Stall Speed Holding Pattern. I'm Jason Daw, your co-host for today's episode, and I'm joined by my colleague Simon Deeley, and we're recording this at 10 a.m. Eastern Time on July the 9th. Now, for some background, Simon and I released our mid-year rates outlook earlier this week, and we're going to try to give our listeners a condensed version of the key things that we're thinking about for the second half of the year and beyond in Canada.
Okay, let's kick it off with a question back for you, Jason. What's happened in the economy last year? We know it was pretty volatile. Had some questions around trade, USMCA, growth was pretty low, some issues in the labor market. Can you give us some more detail on what you've seen?
Thanks, Simon. Yes, indeed. The best way to probably characterize what's happened in the economy over the past year is that it's been at stall speed. GDP growth has been zero, and that's been the result of two unprecedented shocks that have hit the economy. The first one, and probably the most important, has been population growth, which has effectively been zero. And then there has been trade uncertainty, which is probably a secondary consideration, but one that was still important as far as how the economy evolved. I would say that the one positive aspect of what happened was the consumer. The consumer did grow around 1.5% over the past year, and that is a really good outcome against a zero population growth world. So the question then really is 0% growth really all that bad? And I think when you calibrate that against population, which was effectively 0% growth, and labor productivity, which was slightly negative over the past year, 0% is not all that bad and really just reflects the potential GDP for the economy. Now, that's what happened, in the recent past. I guess, Simon, what is kind of the outlook going forward? It seems like there's maybe some more bright spots. Stuff might be looking a little bit better over at least a 12-month horizon, and if not, maybe even in the second half of this year.
Yeah, absolutely. We do have growth picking up, even starting in Q2. If you look at where growth is tracking so far, it's even above 2% early on, judging by the monthly GDP indicators. But going further into the year, we do think growth is above potential for Q3 and Q4. Unemployment rate ticking down. On the inflation side, it has come down a fair bit. So we are, if you look at it from an underlying inflation or core inflation perspective, it's certainly come down to around 2%. We think it should remain around there. But the key aspect here on the growth side is when you have above potential growth, the output gap or the amount of slack in the economy is reducing. And when that happens, the Bank of Canada tends to pay a lot of attention to it. It's really a guiding post for how they conduct policy. So that output gap closing, what we expect to happen in the second half of the year or start to happen in the second half of the year is certainly a key indicator for the bank going forward. On the housing front, things have been relatively soft, kind of nothing too terrible, but certainly moving in a softening direction. We don't really think there's a huge change there. And in terms of the growth drivers, other than that, the consumption side, as Jason mentioned, has been a good driver over the last year. We think that will continue. And then government spending, we're seeing announcements from the government, including on the defense side. Those end up being a pretty solid add to growth as well. But there are plenty of risks in the economy, and we've seen some of that even this week on the flare-up with U.S. and Iran, move up in yields. Jason, what do you think the risks to Canada are on the oil side?
Yeah, the oil side is quite interesting because, up until a couple of days ago, oil was going down and bond yields were not necessarily following suit. So the correlation between oil and rates, like we saw in March, April, even through May, that correlation broke down. And then, over the past couple of days, it started to reassert itself again when oil has started to rise. The question is why didn't, bond yields adjust lower when oil was going down over the past couple of months? And there's probably a couple of reasons. Maybe there was still lingering concern that there would be a flare up in the Middle East and oil would rise again. But probably more importantly was the big narrative shift that happened with the Fed. If you recall, before the U.S.-Iran conflict, the market was pricing rate cuts for the Fed. Now it's pricing rate hikes, and that's affected global bond yields and Canada specifically. As far as the economy is concerned, the Bank of Canada, has cited it as a risk, but it would require inflation expectations rising quite significantly. We saw a little bit of that in the Business Outlook survey, but I think where we are with oil prices right now, let's say around $75 to $85 a barrel, it is a bit in the zone of irrelevance for the Bank of Canada and the economy overall. Moving on to the other, big risk out there, USMCA, obviously it was not renewed on July 1st. What do you think as far as the economic implications of that and the path going forward for USMCA and whether a new deal can be struck?
Yeah, USMCA has certainly been, a key risk ever since Trump came in. The July 1st non-renewal was really the only likely outcome there, as given what the Trump administration has said. But it's not a sign that they don't want any agreement. It's just a sign that they didn't like the current agreement, and that's certainly what they had voiced for some time now. So going forward, essentially, we're in a point where if there's no new agreement struck, we're in an annual review period where the sides meet and discuss potential options for a new agreement, or we end up with a new deal. And so at some point, if they do reach an agreement with changes, and the most likely thing here is you have USMCA acting as kind of the center agreement, and you have bilateral arrangements between the U.S. and Mexico, U.S. and Canada. If we end up at that point, then that's removes any lingering uncertainty for certain businesses, and that kind of there's a uncertainty on how much that will really release investment. It probably helps at least a little, but I think firms are adjusting to the current environment, and when they need to make decisions, they are making decisions. The rolling annual review periods is a possible outcome as well. If Canada and Mexico, for example, don't want to sign on to agreement, the Trump administration doesn't want to exit, and that is one of the key views that we have is that the Trump administration doesn't want to exit. The U.S. in general doesn't want to exit the USMCA. They just want to get some concessions. If the negotiations go that they can't reach an agreement, then you're just in annual review periods. They may want to just wait out until there's a new administration. But we think the most likely outcome is a new deal. We think Trump would want a new deal in order to show that he's made some improvements and praise what he's done. We think it's good for Canada and Mexico as well to reduce the uncertainty. So we do think that's the more likely of the two likely outcomes. And we do think a withdrawal is pretty low likelihood, just because the U.S. could have withdrawn at any time or triggered the process at any time, and they haven't. And we think that's a sign they think it's at least too costly to do that, and they want to move ahead with just extracting some concessions from Canada and Mexico. So, Jason, what do you think this all means for the Bank of Canada? Shouldn't they be cutting rates if growth has been so weak, if there's any concerns on the USMCA side?
I'm going to delineate the discussion on the Bank of Canada into two parts. One is what we think for the second half of this year, and then the second one is what we think for 2027. Right now, we think that the probability of them being on hold for the duration of this year, that probability is high and rising. The probability of any other outcome, them cutting interest rates or even raising interest rates, those probabilities are low and shrinking. The reality is that right now, the current state of the economy is not strong enough to warrant rate increases. Inflation, generally pretty benign on core measures. Inflation expectations are not a problem. The starting point for growth has been soft. Going forward, however, that picture can change. The Bank of Canada is expecting quarterly growth rates for the rest of this year around 2%. If those are achieved, the output gap would start closing, And that would be a historical trigger for them to at least start moving on the monetary policy front by raising interest rates. So this year, Bank of Canada on hold, but there is a clear path to rate hikes in 2027, which we would characterize more as adjustment style hikes from the bottom end of neutral to the top end, around 100 basis points. The timing of when those rate hikes could occur, it is still very uncertain. We've penciled in the first quarter. Could it be the second quarter? Yes. Could it even be a little bit earlier into the back part of this year? That is a possibility, but our base case is at least a Q1 starting point. For them to move over the next few months or even over the next couple of quarters, that would really require a tail risk scenario in either direction. So growth would have to be in recessionary type of territory. There would have to be job losses, which we haven't seen. Maybe that comes because of trade or some other shock, but that's at least not our base case scenario at the moment. And for them to raise interest rates, you need to see really, really robust growth, that happening on a sustained basis, and a serious pickup in inflation expectations to warrant any near-term move. So again, on hold for the second half of this year, but a clear path to rate hikes in 2027. So moving on to the market side, Simon, what about bond yields in the curve? Is there any differentiation between, what we're thinking, kind of short term, let's say the next 1 to 3 months, versus what we're thinking over the next 3 to 12 months?
Yeah, the market side's interesting. What we think short term, so over the summer, for example, we do think it's an environment where front end can perform. There is a decent amount still priced, pretty close to one full hike price for the Bank of Canada by the end of the year. As Jason said, that we don't think that's warranted. So we think there is a timeline for some long front end positions. We think those can pay off, especially given the move we've seen recently. And what that recent move does underline as well is the risk to this. So the risk is that if there's a pop in oil prices because U.S.-Iran flare up, which is what we've seen this week, then you see front-end yields move higher, risk of hikes increase, and that moves against the recommended position. It is one where if volatility is low, then being long the front end makes a lot of sense. And so it is something that we favor right now, but it's not without risks given the U.S.-Iran situation. Over time, though, so say over the next 6 months to a year, we do think the stronger growth profile that we've mentioned and inflation kind of moving to around 2%, not below, and that reduction in the output gap means that the Bank of Canada should be looking at hiking. And what comes with that is a rise in front-end yields. So we do think, for example, by the end of the year, the 2-year yield can move up to above 3%, currently in the mid-280s. So we think it can move above 3% by the end of the year as the market positions for Bank of Canada hikes early next year. And then also that, for yields further out the curve, there's some potential for them rising. We think near term, they're probably more likely lower, similar to the front end. But then over the longer term, we see it kind of flattening out for the 10-year part around 360. So that's the case for both late this year and also into the middle of next year. And so what that generally means is, and this is consistent with what you expect when a central bank is tightening rates, is that the curve is flattening, led by the front end. So front end yields moving higher, curve flattening in general. What about you, Jason? Do you have any strong directional moves based on where the market is at the moment?
Yeah, I tend to agree that over the next 1 to 3 months, the play is for front-end yields to be a little bit lower in Canada, for the curve to be a little bit steeper. And you can even have a situation where a lot of the outperformance that we've seen in Canada versus the U.S. Continues. And I do think that will, ultimately set the stage for a reversal where, the opposite dynamics start to unfold sometime, kind of around the fall period. Some of the other kind of interesting things that we cited in our mid-year outlook, Canada versus Europe, that seems relatively interesting. It's been a fairly stable cross-market spread over the past few months. and it's generally been moving lower rather than higher. And in a world where investors are still favoring carry, that does seem like something interesting for people to consider. The other interesting aspect between relative pricing, Canada and the US in this case, that looks quite disjointed is what the market's pricing for the BOC and Fed from a sequential policy standpoint over the next 18 months. So the market's pricing for the Fed to raise interest rates by the end of the year, maybe a couple times, and for them to be on hold or possibly even cut interest rates in 2027. In Canada, they're pricing a chance of a rate hike this year and then a lot more rate hikes in 2027. Now, it's easy to construct a fundamental story on how that sequencing may play out, but there are many, many different paths on what can happen between now and then, right? It can be data surprises. It can be other things with oil. It can be things on trade. Relative Canada-U.S. growth differentials, how central banks are viewing the problem, that, there is a lot of other outcomes that could happen. So when you look at what the market's pricing from the end of this year to the end of 2027, that relative spread has moved a lot over the past couple of months. And I think it's easier to see a scenario where we start to get some convergence rather than continued divergence in how the market is pricing relative central bank sequencing. Thank you to all our listeners for tuning into this edition of Macro Minutes. The Canada situation is evolving rapidly. The economy has been weak over the past year, but there are bright spots as we go towards the end of 2026 and into 2027. Fiscal policy is possibly one of them. Population growth dynamics may change. The consumer could stay resilient. So we've been used to the central bank on hold. That may change as we go into 2027. So if you have any questions on Canada, feel free to reach out to your sales representative or us directly for further insights.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.